Do yield inversions always result in stock crashes? We have an inverted yield curve here in the US, and not only is the yield curve inverted, it's the most it's been inverted since 1981. I wasn't even alive then. It'd be another 12 years before Frank would come around, and that you add on my 30-year-old age, and that gets you a 40-plus year extreme for the yield curve here, inverted by close to 100 basis points. That's where we got to a couple months ago, and we're right back there here looking at the difference between 10-year rates and 2-year rates. That's usually the benchmark that economists and traders will look at when they're measuring if the yield curve is inverted. And it's not what you have to look at, but it's what is most oft quoted. Similar to if you're quoting, the stock market did this today. Usually you're looking at the S&P 500 or the Dow Jones. If you're quoting inversions, you're usually looking at the 2s versus the 10s. And it is not only inverted, but it's pretty darn bad. And it raises this question because you might say, hey, this is the worst inversion since 81. And maybe you weren't trading then, maybe you weren't alive then. But I do remember in the early aughts, in the later aughts, in around 2000 and around 2007, we had a yield curve inversion. And I also remember around those times, we had a stock market crash. Raises this question, and also you go back to the 80s, and there was definitely some stock market turbulence, as I believe the 1.5-year stretch, the 18-month stretch starting in 1981, produced a 30% down stock market. In the latter part of 82 and 83, it bounced back to actually be positive for that 3-year stretch. But nonetheless, stock market crash then around the inversion, stock market crash around the inversion of 99 into 2000. Of course, that being the dot-com crash. And then also you get this inversion in 06 and 07, and you have the financial crisis of 07, 08 there. Leads to this question of, is a stock market crash a necessity when we see a yield curve inversion? And now that question, I can answer that theoretically, no. Of course, yields operate differently than the stock market. And the reason that the yield curve is inverted currently is for very relatively normal and explainable reasons. So no, it doesn't necessitate a crash, but and this we'll dig into, and I think by the end of the segment, you'll understand what I'm saying when I say historically, a stock market crash has resolved a yield curve inversion. And it's not necessarily that a yield curve inversion requires a resolution. We can theoretically have an inverted yield curve for years and years and years, forever, theoretically, which would mean that the interest rate you pay to take on debt, or the interest rate you get paid to loan out money, is larger for shorter time periods than it is for longer time periods. Theoretically, yes, we can be inverted forever. It doesn't need a resolution. Historically, every yield curve inversion throughout the US's history of treasuries and debt and everything else here, it has been resolved. It's always gone from being inverted to uninverted. And so you would think that at some point it will normalize, will come out of inversion. And when I say a stock market crash has resolved this, historically, at least the last 3 times that we've seen this yield curve inversion, here in the 07 range, in the 2000 range, and in 1980 range there, that is to say, when we go inverted in terms of the yield curve and short-term interest rates climb higher than long-term interest rates, and I'll show you our current yield curve here, not only the 2s and the 10s that are inverted by close to 100 basis points or 1 full percentage point, but you can also see the 1-month and 6-month debt is even higher than the 2-year, 5-year, 10-year, and 30-year debt. So a pretty clear inversion, short-term rates higher than long-term rates. This has occurred because inflation, the economy was doing quite well coming out of the pandemic. Stock market's making new highs, and people are spending. Inflation runs up, and the Fed needs to hike interest rates. Now they control short-term interest rates. And so when they hike to 3, 4, 5%, where we currently are, short-term interest rates are directly affected, and they climb. But if inflation is transitory and the market expects that inflation will be calmer by 5 years out, by 10 years out, by 30 years out, then those interest rates will rise with the Fed hiking short-term interest rates, but sometimes don't rise as much. So like I say, a very explainable, practical reason for why we're inverted. And everybody out there who stamps their feet and says that the stock market has to crash now, we've seen this inversion, it has to crash, to a point that one of the most experienced traders that I've ever met, and someone that I'm very proud to call a friend and mentor, Tom Sosnoff, would tell you, if something has to happen in the market, it will have already happened. And so if a yield curve inversion, if there is no way that a yield curve inversion can occur and be resolved without a stock market crash, then the market would have already crashed. Traders and the market and money always gets, if there's something that it knows and it's meant to get ahead of, it will happen. Now, to my point of historically, the stock market crash has resolved yield curve inversions. You go back to this chart, and you see that the blue line there, the yield curve, essentially the difference between 2-year and 10-year rates, it's dipped down to 0 and gone negative, and then has come screaming higher out of these crashes. What's happening? Well, the stock market is crashing in those periods, and the Fed, to mitigate some of that bearish sentiment, to get the economy jump-started again as we're crashing there, they bring interest rates down. And not only do they bring them down, they crush them. They will sometimes cut interest rates 100 basis points, even more at a time, to get that economy to catch its footing, essentially, in the midst of that crash. And so again, the stock market crash has historically solved the yield curve inversion, but right now, the NASDAQ is racing back to all-time highs. The S&P 500 is up considerably here in 2023, and the yield curve is still inverted. And again, one doesn't necessitate the other, but to become uninverted, we've seen usually a stock market crash and the Fed lowering short-term interest rates, and that's how you see that blue line screaming higher, is because short-term interest rates are screaming lower at those times coming off of that stock market crash. We can see the same here, where 5-year, 10-year, 30-year rates stay around 3 to 4%, maybe even fall down to 2.5%, 2% if we were to see a stock market crash. But those 1 month, 6 month, and 2 month rates can go all the way down to essentially 0%. As we've seen historically in the midst of rocky economic times there. Now, what's the alternative? Why hasn't this stock market crash happened? Why does one not necessarily necessitate the other? Well, going back to the reason that we have this yield curve inversion, inflation shot up, the Fed hiked interest rates, and short-term interest rates climbed quite high. Longer-term interest rates said to themselves, this is transitory inflation, so we'll move a little bit higher with you, but we're not going as high as 5 or 6 or 7%, because inflation is likely to come out by the end of 2024 or 2025, by the time you get to a 5-year or 10-year or 30-year rate, so we won't climb as much. Well, if that is correct, and inflation cools and the stock market doesn't necessarily crash, then short-term rates could just come down to 3%, 3.5%. And here you have the projections for the end of 2024. The market expects short-term rates to not necessarily go crash down to 0% because there's going to be a stock market crash, but inflation normalizes, rates normalize down to 3.5%, and you could have this inversion come out just by 5-year, 10-year, and 30-year rates staying around 4% or so, and 1 month, 6 month, 2-year rates coming down to 2.5%, 3.5%. That's the way that the market is hoping things happen, and that's why you have an up stock market and still a yield curve inversion. You can have inflation come out and those rates normalize in a relatively healthy way. But of course, you look at history here, and history, though it's a very, very small sample size, it's really as small as it can get, 2 or 3 samples in the sample size. History does say that a crash is more likely. We don't have a lot of occurrences of inflation rising, interest rates in the short term rising quite rapidly, causing an inversion, and the stock market not seeing downside. But maybe 2022 was the downside, the slowdown that we needed to get inflation lower, and yields will normalize in the coming weeks and months and potentially years, with the stock market not crashing. One doesn't necessitate the other. Historically, we have seen them in tandem. We will see how this one plays out.